Okay, we should be live.
Awesome. Great to see everyone again. This is episode number 61. Hard to believe it. Here is Daniel Pronk, as most of you know. You just passed over 250,000 YouTube subscribers, so congratulations there. Freaking incredible. We're both business partners creating Stock Unlock, and we go live to do some group research, talk about stocks we're buying or selling. We're just huge stock nerds. It's all we really think about. We love looking at financial data and have really been enjoying talking to everyone about it live here, whether you're listening on the recordings or with us live. Daniel, I think you have been talking about HIMS stock a lot, and why I think this is a fun chat is it's a pretty controversial stock. You've been getting a lot of flack for this online. So I guess just in a nutshell to catch some people up, what's going on, Zion? Seems like he bought some HIMS today. Why do you think this is such a controversial stock, and how is it fitting into your portfolio?
Yeah, this one's weird. This has been one of the weirder stocks that I've ever owned because I made a post on X or Twitter when I bought the stock and posted some quick research on it, and the response from the community was I would say 50-50, but the response was either extremely good or what the hell are you doing? This is a terrible idea. This is not who you are. You're going against your investment principles. I thought you were a value investor, which I don't even like that term at all, by the way, but that's off topic. So yeah, I don't know why this one is so polarizing. I actually also had someone on X tell me that they just think that this one's a meme stock. So somehow HIMS has been bucketed in to the meme stock craze. And I don't know if that's just because retail investors are so bullish on it and the institutions tend to not be bullish on it. But yeah, it's a very polarizing stock.
I think it's because it's grouped in with the SPACs, and
it is a former SPAC. Yep.
To be fair, SPACs have been pretty horrible. Let's go look at a different SPAC actually, which is Clover Health. I have not checked this one for a year, so oh wow, look, it's up with the rest of the market. But let's zoom out on this graph, maybe more. Okay,
there you go.
This one's actually having a little bit of a comeback, but this is what most SPACs look like.
Yeah, SPACs did not do well. But the thing is in investing, I don't think that you can apply one statement to everything. I think everything is situational. So I wouldn't want to just say SPACs are crap. I think that would be unwise. So I think that, most SPACs were crap, but that doesn't mean 100% of every single SPAC is a bad business. And that's just, I view everything in investing like that. I try not to apply a blanket statement to anything.
Yeah. I'm going to try to concentrate as sun comes through my window and I'm getting blinded as I do this. I'll need to pick a new spot to sit soon. But yeah, I thought, well, okay, let me clarify this. I bucketed HIMS with meme stocks, but not in a serious way. I think the reason why is if you talk about meme stocks, if you hang out on Twitter a lot, there's definitely names of people that are more I don't know if you'd call them memers, but Tesla crowd, PLTR, NVIDIA. And what gets a little bit weird about these is some are right and some are wrong. But I saw HIMS being thrown around with all those names. So in terms of me just bucketing names together, I'm okay, HIMS has some weird cult following online. And it's the same people that own these other stocks that I don't have too much negative things to say about them other than that they're just not for me. However, in our Stock Unlock Discord, people started talking about this a lot. You started talking about it. And I'm okay, I do not want to be I'll stop sharing my screen here. I do not want to be the investor that is missing opportunities because I'm making assumptions about things.
Yeah.
And the more I look into this one, I don't understand how this is a meme stock at all. Yeah. If you look at the financials, it's great. They're growing well. I think that if we want to talk about the bear arguments, I think the GLP-1 comments, there's some correctness to that, and then some nuance in terms of how they were growing before, as well as also people looking at Amazon and other big players and questioning their moat. I think those are all super valid things, and I keep surprising myself because the more I look into it and then go back to your videos and stuff, not that I'm agreeing on 100% of things, but yeah, it seems like a very interesting one to me. It doesn't not look like a meme stock. It looks like a real business.
Oh, it's a real business. Yeah, for sure, it's a real business. But no, I agree. Like, there's actually one person on X in specific who I don't necessarily like. Um,
Who is
I
it?
won't. I'm not going to say who it is, but they post a lot of X or tweets or whatever you want to call them. Just like this stock is going to be a 100x, and like Palantir today, Palantir is very expensive already, and they're still like, this is going to be a 100x investment from today over the next like 5 years, and I'm just like, that's crazy. Okay, like that is crazy. Then they're also saying that Tesla is going to be a $20 trillion company. So like, this is the type of person that I'm talking about on Twitter. This person happens to also own Hims, and they post about Hims the same way. So that's what I'm trying to say is I agree with you. Like, the retail investors that historically have seemed to own Hims and like really be loud about it are also the people who are like, Palantir is going to become a $5 trillion company. Tesla's going to be 20 trillion in 3 years. And it's like, that stuff's kind of outlandish, man. So yeah, I don't think the perception of like the investors who have been so loud about Hims are like the most credible people, I would say. And I think that's why like my audience was very shocked when I bought it.
Yeah,
So
I'd say
maybe that's
different
why.
styles and different temperaments could even be like a more
Yeah,
fair way. Like people who are like super risk on and also just say these very bombastic like statements that
exactly.
probably are making them because they're getting like ad payouts through social platforms and like show me the incentive, I'll show you the outcome type thing. Maybe there's a
Exactly.
cute story here because I find that there's like two camps of investors online to really overgeneralize. If we're talking about investing and not really including options or crypto, I know it gets pretty dense, but let's just talk about buying stocks. In general, you have people who are like seeking hype, trading in and out, and like only trying to 10, 20x. On the other side, you have more of what I'd even call like a boring or like mellow crowd, which I'd put us in, which is like, hey, sure, like we want to get good outcomes like that, but like realistically, if you're beating the S&P, which is 10% a year, that's actually pretty good, especially when you compare it against the best investors of all time. And maybe Hims is the bridge to like connect us all together. We put our differences aside us and agree on one thing.
Well, the thing is too is like, I agree that Palantir is a great company. What I don't agree on is like, at today's price, it's going to 100x in 5 years. Like that, no, I no, I can't. I'm not going to agree with that. So I think maybe why the bridge is being connected is because Hims, in my view, is not expensive at all today. Like, when you look at how high their margins are, how quickly they're growing, and the price ratios, when you, in my opinion, do the proper math, it's like, it's actually still a pretty cheap business with a phenomenal balance sheet, great leader, great CEO, founder, and like addressing real issues. So it's like, it ticks all of my boxes, and then it's also selling for the right price. So I think that the price kind of bridged the gap there.
Yeah. The one bear argument I don't hear people talking about, and also while we talk about this last point, if anyone in the chat wants to bring up a stock or a topic for us to talk about, let us know. We see you guys there, and thank you for coming to hang out. So just to put some framing around this bear narrative, I am not presenting this as this is why Hims is negative or this or that, but it is an angle that I just don't really see people talking about online. Is Hims is an arbitrage, in my opinion, on a broken healthcare system in the United States.
Yes.
I worked at a health insurance company, which is Oscar Health. They're public now for 4.5 years. Not to flex on the chat, but this is one of those topics that I do feel like I have a little bit of an edge on it. And the issue with healthcare will take probably a half an hour to describe, so I'll have to give it to you guys simply. But there's an incentive at health insurance companies to deny claims and not give a lot of coverage. There's a lot of complications between deals that health insurance companies need to make with provider networks, the rates that they agree on. And at the end of the day, a health insurance company, even though they're there to give health insurance, they are a business. A lot of these companies are public. And when you're public, you have to show profits for your shareholders. You have to be a viable company. So for every dollar of claims you take in, you need to pay out less than $1. Fast forwarding through, that has created some interesting behavior. So for example, the drugs that Hims are covering are sometimes non-essential. They are drugs that insurance companies have a hard time covering because it's not hiding some condition that you have. It's like a little bit hard to kind of like convince these health insurance companies to like pay for someone's like weight loss, even though it makes sense. I know it does. It just doesn't work out that way. And in my mind, HIMSS would not exist if the health insurance industry and healthcare actually worked the way it was meant to work. Now, taking a step back out of this, I don't see this as an issue for HIMSS because having worked in the healthcare industry, it's a mess. And I don't think it's something that's easily fixable. And I actually think that HIMSS may be defining a new category that could redefine what is health insurance for, and like what are these like second tier things that you don't need to survive, but that are good, like reverse balding, lose weight. So I don't really I need to finish formatting my thoughts there. But one like risk I see is potential reform in the healthcare sector, as well as telemedicine laws, which have been expanding as of late. But like Trump is a very unpredictable character. So I actually have no idea what will happen in the next 4 years regarding those laws. I doubt much will, but that's just like one thing that could potentially harm their business if there was regulation frameworks and things changed that would actually push people back to their health insurance companies and try to like kill this middleman industry that's really like an arbitrage on a broken system, in my opinion. I still bought some stock, by the way. I'm just saying like I don't hear people talking about that.
Yeah, I think regulations are definitely a risk. Like, to be clear, I think HIMSS does carry more risk than some of the like top stocks in my portfolio, which is why I haven't made it a huge position, but I did want some exposure. I view the risk reward there as like higher risk, higher reward, but also the higher risk results in me not making it like a 10% position or anything like that, you know? It's all about position sizing as well.
What allocation would you stop at? And if the stock grew naturally on its own, would you ever trim it if it went over?
I pretty much only trim stocks if I feel like they're getting to a point where their prices are insane. So if HIMSS stayed in a reasonable price level relative to its fundamentals, then I would not trim it. I don't trim my winners just for the sake of reducing their allocation in my portfolio. That's something I don't do. So I only trim if the stock gets extremely expensive. And even in those situations, as you've seen, Jake, I typically don't trim in those situations either. I'm out. I'm done. So no, I would not sell HIMSS no, that's just not how I think about it.
Cool. Sweet. Let's move on to another topic here. I'm going to look at the chat for some questions. And Daniel, if you see any stocks in there that people are bringing up, feel free to add it to the queue. From Tree Poloski, good job on those extra brokerages. Yeah, we do have interactive brokers. Finally, I know you guys have been asking for it for a while. If you don't know what we're talking about, we're co-founders of stockunlock.com. You can connect your stock brokerage there. So yes, interactive brokers, public.com, Wells Fargo, Chase, and Bucks have all been added. We work with brokerage connection partners here. So we are kind of like at their whim for what they are choosing to support. That being said, there are more than one provider for these connections. It's just that we take security extremely seriously here. So we will consider looking into some other connection partners to broaden how many brokerages we connect to. But the simplest way to let yours be known is just hit support@stockunlock.com. I think you have Disnat here, and we could help you with that request.
Okay, so moving on. Andy69, nice, says, been posturing you about BEPC in the Discord, but now would be a great time to look at it. Okay, so I'm not going to talk about BEP in specific because I'm actually making a video on them soon. But so I'll explain my full thoughts in the video. But in general, what I've noticed after taking another look at BEP is renewable stocks are not hot right now. Every renewable stock that I've taken a look at is like down big. And I mean like big down. Which is getting my interest peaked because like these businesses are trading for all-time low historical price multiples. So I was doing some research into why this is. And it's simply because Trump apparently does not like renewables at all. Like he said the other day, during my presidency, I don't want any new wind power built at all. There's going to be no new wind power in the United States. So obviously, if you're a company like NextEra Energy Partners, where you have a lot of wind power, that's not good for your business. So this is just like, I think this is just what the next 4 years is going to be, man. Trump just like says things And then you just got to wait and be like, okay, is he true? Like, is this real? Is he following through, or is this just like another Trump strong arm thing that he just doesn't follow up on? But regardless, his comments have caused the entire renewable sector to fall, like significantly. And whenever I see an entire industry fall, I think that you can pick the highest quality companies in that industry and find some serious value. And after my research, I think Brookfield Renewables is actually the highest quality renewable company that I found. I will discuss this in my video more, but yeah, it's looking very interesting, I would say. Again, I don't think I'm going to buy it because it's a very high dividend paying stock and they're an income stock. But, you know, if someone likes income in their portfolio, then I'm not saying go and buy it. I don't make recommendations, but I will say go and look at it, research it, because if you're interested in that industry, now's the time to look, in my opinion.
Well said. I don't look at renewable stocks. So
yeah.
Rob H has a great question here. Do you have any regrets about the moves you did or did not make in the market in 2024? We're also going to ask this to the chat. So if you're with us live, let us know. What were your biggest regrets or the things you did not do regarding your stock investments in 2024? Daniel, does anything come to mind for you? Maybe like a sell you wish you did not sell, or like a stock that you were thinking about buying and you did not buy and then it ran up on you?
No, I don't have any regrets. This is a good, or yeah, just a good question. So what I actually did for my Patreon community is I went back through every single decision I made in my portfolio in 2024 throughout the entire year. And so in my personal portfolio, I'm pretty much fully invested all the time. So when I sell a stock, that money is moved into a new stock immediately. So it's very easy for me to track. I sold this stock, money was placed over here. How did those two stocks perform relative to each other, and was the decision good? So in 2024, when I looked at my performance and all of the historical decisions I made, it was 50-50 in terms of, did the stock that I buy go up or down after? I don't know a good way to explain this. In terms of did it work out better or worse? It was a 50-50. But with that being said, I also looked at the percent returns on the decisions that worked out versus the other decisions. I really don't know how to explain this well, so I'm sorry. But the moral of the story here is, even though 50% of the time the decision was good or bad, the percent return on the good decisions was significantly higher than the decisions that were not good. So to summarize all of that, in terms of performance, I made the right decisions, even though I didn't make the right decisions 100% of the time.
So you're going to get the no regrets tattoo on you?
No regrets. Yep.
No regrets.
So no, I don't have any regrets. And I'm going to continue tracking my decisions like that in the future. Because if I see a streak of like 3 years, you know, where every decision I make is like, if I were just held the stock, I would have performed better, then that's a clear indicator that maybe I should just stop doing things. So yeah.
It is funny, like when the less moves you make, I feel the less opportunity you have to like make mistakes.
Yes.
I've actually taken that too far. So I am, this will all be relevant. I am 32 years old. My father, when I was younger, nothing super huge, but did have a modest stock portfolio with some tickers in it. And when I was in my like, maybe let's say 23, 24, and keep in mind, I didn't get super into investing until around like 27, 28. I just got handed this. And at the time, my dad told me in that moment, who isn't like a huge stock guy, by the way, but does a little bit. He was like, yeah, you know, like these are all good names. Just like, don't sell them, just like hold on to them. And I'm like, okay. Like I didn't really know any better. Flash forward now. I realized I was like with my dad maybe 9-10 months ago, and I brought up some of these stocks. He's like, what stocks? Oh yeah. Yeah, I think I sold those years ago. Yeah, I don't know. Like, do whatever you want. And like, I've been living in this world where it's like, oh, like trusting your dad is good, by the way. So I'm not saying this in a negative way, but with family and stuff, it was one of those weird things that I wasn't consciously aware of. The fact that I wasn't challenging myself on it. I had these like 4 tickers in my portfolio that I knew absolutely nothing about. And I just like got rid of like weird mental barriers there. So super happy I sold those. There was one that for one reason or not I didn't sell. It's like a company my uncle works at, and like I don't know, he works there. Really stupid reason to hold the stock, but I was like, let me just hold it, see what happens. It was up like 200 something percent. Now it's like hitting 52-week lows and stuff, and I'm like, I still don't know what this is. Should have sold it. So those I guess are like some regrets looking back. Just Daniel, you actually said something to me this year that really stuck with me, because I feel like I am more conservative than you in terms of holding cash, and it takes a little bit more for me to just like move money around at the rate that you do, and I don't have a good reason as to why. Mostly anxiety and stuff. And you said something to me that really stuck with me, which is like, hey, look, like I spend my whole life investing, studying stocks. I'm very obsessed with it. I genuinely enjoy it. I trust myself. I also only have one life to live, and like compounding years are real. So like you basically were like, yeah, like I know that technically like I could be wrong. Like it's happened to you in the past, like it's happened to all of us. But in terms of like taking risks and viewing things through that lens, it does kind of open things up a bit, where it's like, hey, like maybe I should like lose my anxiety and like spending and moving around a lot of money. Like we were a family where it's like when you go out to eat, it's like don't even like really order a drink, just like get water. So I feel like that's like been in my brain living rent free for a while. So I guess the summary of all this is it's like we all have like baggage in our heads, and like we are not consciously aware of it. So like talk to people that challenge your thinking. And if you find yourself not able to explain, asking yourself why 2 or 3 times why you're holding certain stocks, don't be afraid to make bigger moves. That's not advice. Everyone's portfolio is different, but yeah, I had a lot of regrets after doing that, where I was like, why didn't I do this sooner? We could also talk about stocks like Netflix, because we both missed that. I think that could be a fun conversation. It's like we were shitting on Netflix on these calls, and we were dead wrong. So we could talk about things that we all missed as well.
Yeah,
you look very pensive.
I don't know if I would necessarily say that I was shitting on Netflix. I definitely wasn't like bullish on the company, but I wasn't like, this company's going to zero. But no, they turned it around. They turned into a free cash flow machine. They're clearly winning streaming. And I think that company's doing all right. I do think that it is looking pretty expensive today, though. Yeah, I don't really know anything else to talk about that.
The interesting thing for me is like just talking about moats.
Yeah. Okay.
To me, it does seem like in the age of streaming, people are trying to figure out like, okay, like where's the moat, right? Like anyone can create content, anyone can create TV shows. And then in terms of who has friends and who's buying the rights for the shows that they already have, like it just seems like a money spending game, even for like getting sports on the network. We see like Amazon Prime, Netflix, like all bidding big contracts to like get like just a couple NFL games. And it just seems like a place where people are throwing money around. One thing like I learned this year, which seems obvious saying it, but in terms of creating your own new content, it's basically like what Disney has done. I mean, like this isn't a new moat, but it's just applying to streaming companies way more hardcore than I thought. Like I actually was doubtful of Netflix's ability to create very unique content that is like unique on their platform, because there's not that many Disneys in the world, right? Like doing that is incredibly challenging. And I'm like super surprised and impressed by them. Like they seem to have been forming some kind of a content moat. And
oh yeah,
in terms of diversifying their revenue streams, they were getting a lot of flack for an ad-supported tier. That has exploded their business and also given them another vector of revenue for getting ads in the door. So they've been doing good.
Yeah, Netflix also has a lot of reality TV shows that just go viral. And like sadly, my fiance watches a lot of these reality TV shows, and then me naturally hanging out with her, I'll watch them too. And like for some reason they are addictive, and it's crazy.
I'm judging you right now.
Yeah. No, look,
What's your favorite one? What's your favorite one?
I don't know.
Oh, like, come on, dude! You're such a Bachelor guy. I can already tell.
No, I do not like The Bachelor. Love is Blind is interesting, even though I strongly disagree with the concept. But hey, people get married; it works out.
What's the concept of Love is Blind? In like a nutshell.
So they get a bunch of guys and ladies together, and they talk to each other through a wall without ever seeing each other. And you have to form a relationship. You have to like suss out everyone, pick a partner, talk through the wall. You don't see each other, form a relationship, and you end up getting engaged through a wall without ever seeing each other. So it's like, it's a big experiment to see if that actually works. And I'm just, and the reactions on that show are just funny because there's times where like, you know, they get engaged and they finally meet each other and they see, and then they're just like, yeah, that may have not been the best move. So yeah, I personally think it's important to be attracted to your partner, you know.
Let's keep talking about stocks. You know, if anyone wants to talk about Love is
Yeah.
Blind, we're gonna go into the off-topic room. I like regretted asking that question halfway through, but I'm really happy I heard your response.
Yeah, it's that's the type of shows Netflix makes that people, and they go viral online and people watch them. So
Okay, Fox, moving us along here. Also, a heads up, probably 5 or 10. Daniel and I, we're actually traveling to Japan on Sunday, so
yeah,
we are definitely have a lot on our plate in terms of getting the business set up. But Fox here is saying, I think has to be Kodak, KODK. A company's market cap is below its cash reserves. Is the market questioning its future potential? I mean, sure, but yeah, let's check this out. Is Eastman Kodak? I just want to. Is this the camera company? Like, are they actually still alive?
yeah, I think so.
They IPO'd in 20. Did they go private and then go public again? All right. If anyone knows in the chat, I'd be curious to hear. But let's see. They are trading with a market cap of 590 million, just shy of 600 million. They have a horrific insight score. So let's just quickly get a cursory view of their business. They are unprofitable and losing money. They do not have a good return on capital invested. It does look like they have a decent amount of cash runway, so we will get to that. But yeah, this company is not making money. So my first thought is, well, if they're not going to start making money soon, they're either going to have to dilute, raise debt, or do something. If we're looking at their cash flow statement, it looks pretty bad. All this red right here actually means that this is the revenue line, that the revenue is going down. This is terrible. So you never want to see a company that looks like this. Wow, this is one of the worst revenue charts I've ever seen. Okay, this is really bad. I don't need to explain to you guys that revenue going down is not good at all.
Sorry, I'm laughing at your reactions, Jake. I'm not laughing at the stock suggestion. I'm laughing at you.
You please laugh at me as much as you'd like. All right, let's look at the total cash. So cash and cash equivalents. That's weird. Let's try quarterly. Cool. Cash and cash equivalents is at 214 mil. So I'm not sure. I'm seeing that they have about half of the cash as their market cap, unless if I'm missing some other cash equivalent assets here. But it does not look like their market cap is less than their amount of cash on hand. Oh, this is great. The company has been taking out debt. They are unprofitable. The share count is having some slight dilution from SBC that we saw before, and they're not really taking in cash from operations. It's actually negative. I don't think I need to say my conclusion here. I have not looked deeply into this business. The only thing that could be a bull case for me here is if there is some product or service or future not yet realized revenue that this business will be able to achieve. In order to figure that out, I'd go to their investor relations materials and look at their CEO. But yeah, Fox. Let me know what you're seeing in this one, because of course 5 minutes on a stock is not enough. But I did not find anything good there. So that's the review of Kodak. I guess I didn't look at the insider transactions, but
yeah, what I would say is I have actually seen businesses before where they were trading below their current cash value. Kodak, I don't think we saw that was the case, but I have seen it before. And you have to just think about it logically, okay? If you buy a business, like with your real money, let's say you go buy a business, it has $200 million in cash, but it's losing $50 million per year. Is that business worth $200 million? In my opinion, absolutely not. Why? Because yes, it has $200 million today, but after 1 year, it's going to lose 50 million. Then it's going to be at 150 million. then 100 million, 50 million, then zero, and it's going to be worthless. So it's not just about looking at how much cash or whatever the business has today, but also, is it even profitable? Is it losing money? Is that cash going to literally light on fire over the next year? Like, where is that cash going? So I think that it can be dangerous to just look at a stock, look at its cash position and be like, oh, well, it's cheaper than its cash position without looking more, because a company can not be worth its existing cash position if it's going to lose that cash in the future, right? So
yeah, well said.
That's how I would look at it.
This like ties into some other comments in the chat too, bouncing back to our other deeper conversation of investing that we had before this. If you're just joining us, you could watch the recording. But Andrew says, they say most investors spend a lot of time before you buy a stock, and when they question their conviction is when they lose the most money. So tying this back to Kodak, you saw Daniel and I trying to build conviction on this stock. Obviously, like that did not happen. And as Daniel pointed out, is deeper than just looking at a few stats. So I know that you guys and girls are not doing that here. But yeah, even with Kodak too, like seeing that stat is enough to like take a look. And we could be wrong here and have another Netflix moment, but
yeah, to build on what Andrew is saying, we're getting near the end of the stream right now. But what I have been telling my audience on YouTube and what I've been doing in my portfolio while the market has been high and it's been harder to find value is what I've instead been doing is trying to build the conviction that I have in the stocks that I own, so that if I'm not saying we're going to see a market correction or anything like that, but if we see one, when stocks fall, they tend to rebound quite quickly. So what I want to do is, if stocks do end up falling, I don't want to be in a situation where I'm questioning my convictions when the stocks are down. So I want to make sure that my convictions are in place. I feel very secure with the positions I own, so that if we see a market correction, again, not saying we will, but if we do, then I can just immediately seize opportunities. I will not have to sit around and question or do research. So that's my opinion right now. My chair just lowered itself. I don't know why, but I don't know if you saw that.
I didn't see it, but like I looked at the chat and looked back and something changed. So I'm like happy you said it, because I was like, did the camera zoom out or something?
No, this chair has been doing that. I need a new chair. Just like randomly goes down.
Cool. All right, let's take one last question here, and then Daniel and I are going to wrap it up. Normally we go a bit longer, but life calls, literally. Let's take this one here. Oh, no, wrong one. What do you guys think of Oscar Health? Well, as I mentioned, I worked there for 4.5 years, from 2017 to 2021 through the IPO. And I think it's been long enough where I'm allowed to talk about things. I do not have insider information. This is not investing advice, but I do want to put out a big disclosure. I own way too much of this stock.
A lot,
which is like ridiculous because anyways,
Jake, your net worth is directly tied to Oscar's share price.
Yeah, no, like quite literally around like 1/3 of my entire net worth as an individual is in Oscar stock. The reason why, just to be clear, I did not go out and buy that stock. I have never bought Oscar on the open market, not once. I have these because I was an employee there and like got a pretty good deal in 2017 where they like lock in your share price. I'm like, okay, well, if you're going to give me money and I earned it, I'll take it. And I'm still holding those, by the way. Oscar Health in a nutshell, and don't worry, Daniel, this won't be too long. The vision of Oscar Health and why it was founded is, as we were actually talking about with HIMSS before, which is kind of funny because Oscar's trying to create HIMSS products, by the way, something to look out for. Or rather the CEO, Mario Schachler, he came from Europe, also like had a baby in the US and went through the healthcare system and was just like, that was such a nightmare, pathetically horrific scenario. Like my entire life mission now is going to be to like fixing the healthcare system. He's of course some like entrepreneur dude. He hooked up with Josh Kushner, who is Jared Kushner's brother, who yes, is married to Trump's daughter, just to be very clear on the relationship there. And the Kushner family is like super hooked up, has tons of money. They somehow end up never losing. And I will not double click on that. You can by doing internet searches, but the Kushner family, they got things dialed down. Oscar Health is heavily funded. It's taken in billions of venture cap money and now it's public. Their whole angle was to revolutionize the tech stack and deliver personalized care. So one thing a lot of people don't know, and this is good for him's like adjacent research, not directly to them, but claims processing systems in the health insurance space actually have not been updated since the 90s. There's systems called impact and other weird industry terms where you actually have this like cobalt code that's maintained by these dinosaur companies. And because healthcare is so regulated and HIPAA compliance and everything, the cost to create like a new claims processing system, especially before the age of AI, was just an undertaking that most people could not even imagine. The complexity of administering a claims processing system is something that I would bore you guys all if I talked about it more. So bringing it back to like a conclusion here on like what is the premise of OSCR, and then you could go do your own research, is they have, after 10 years, and I know the engineers that built it have in-house their own claims processing system. That is actually a moat, in my opinion, a competitive advantage that most people don't actually understand, because most people don't understand how the tech stack works when you're running a health insurance company. There's two factors of this. One, the cost to actually license it. And then two, the granularity and control you have of the claims processing system and the customizability of it, which directly impacts the company's MLR, which is their medical loss ratio. To say that in regular human speak, it's what percentage of claims are they denying and accepting? Because again, for every dollar they take in, if they pay out 80 cents, that means that they have an 80% medical loss ratio, and that other 20% is going to be used for headcount, selling and admin, all that other stuff. So they're definitely unique. They're different than other health insurers in that they were one of the first licensed health insurers in over like 10 or 20 years. They really cracked into a dinosaur space, and they've been around now for over a decade. They have the claims processing system built, which took them 8 years. It's called Ocelot, by the way, if anyone wants to sound cool and freak out people that work there. I don't think that's private information, but that's the technical name for it internally. And I think that they're a pretty interesting company. Do your own research, but yeah, they're different than a lot of other health insurers. And if you're into like Lemonade and other companies like that, I think there's a lot to research there. Just be careful because it's a super dense, complex space.
Yeah,
and maybe that's a good way to end it now too. Daniel's doing the little glasses fidgeting.
No, I took a look at OSCR last night actually, because Nate O'Brien tweeted about OSCR stock, and he's like, if anyone knows anything about OSCR stock, let me know. So I took a look on Stock Unlock, and OSCR's revenue growth has been insane. But the one thing that I don't like about them is it looks like they're still losing money. So like, yes, the revenue and the business is clearly growing, but yeah, it looks like they haven't been able to turn a profit yet. So one thing I don't know anything about this business, but like I would want to know exactly why that's the case. Because, you know, they could be investing in growth and it's clearly working, but
yeah. The things to look at here. So I'm looking at their financial statements now. They actually are positive net income. However, there's probably nuance to that that I have not looked into yet. The things that you want to look for OSCR Health is their gross premiums earned growth, as well as the number of people they have insured, as well as across like different product areas.
Yeah, sorry.
So I'm looking at the total members right now, and their total member CAGR, let's see, is 45% over the last 3 years, growing from a base of 400,000, and now they're at 1.65 million. So yes, Dan, you are right. It is a spend game. So they like spend into the growth and try to keep the CAGR of their premium members high, because at the end of the day, it is a little bit of a commoditized product, just like a bank, where there are a lot of companies that sell health insurance, and you do end up like competing on like distribution and brand name and the little like bells and whistles features that try to keep people in the door. But yeah, that's the one thing that I don't like about health insurance companies. They're very similar to banks to me in that highly regulated space. You got your big players, but they're all offering a similar thing. And then people just go to whatever is like the best experience. I actually think OSCR Health experience is like pretty great. And they have the tech stack. They remind me of Equitable Bank, actually, Daniel. I think OSCR to the health insurance industry in the United States is equivalent to your bull theses on why you believe Equitable Bank has a moat for Canadian banks. They're giving a great service. They're using the money coming in to make it better. OSCR's a little bit different, but hey, I think we're at time here. So
I gotta go get ready for Japan, man. We're leaving for Japan in a couple days, and I have not packed.
No, you said a rhyme, I thought. You said we're going to Japan, man.
We're going to Japan, man. Let's go.
Stick to the stocks, not the wraps. All right. Thank you for hanging out, everyone. This is always super fun. Love hopping on these calls once a month. And for everyone supporting Stock Unlock, thank you. If you're listening to the recording, come hang out with us live sometime. I love talking to you guys in the chat. Andy69, nice. Thank you for that, Router. Great to see you. OB_R. Thank you for that great question. David, Patrick, Steven, Fox. Missing a few of you, but appreciate everyone that comes to hang out.
Yeah, thank you everyone for tuning in. And we'll see you next time. And we'll have some Japan stories, I imagine.
You and I will be rapping Eminem at the karaoke bars. All right, I'm going to hit the end stream button here. See everyone next month.
Bye.
Cool. I think